Today, I'm going to try and give you some basic information on something that affects all of us. It's taxes. Most of you pay taxes, I would assume. And I'm going to talk a little bit about your Celtec business and how these taxes are going to relate to you, because the government literally demands anywhere from 15 to 40% of your income every year. And I'm going to talk a little bit about investments if I have time, but basically I'm going to keep this talk to taxes. We'll try and keep it informal, and I'll try and make sure there's time for questions at the end. I want to welcome all of you. As far as I can see, you're all double diamonds to be. And this has been a year of big changes for me. I came from the corporate world. Some of you may have remembered that from last year. I was a stockbroker and a financial planner for about almost 14 years. And last July, I moved over from the corporate world into Celtec full-time. And I've gone through a lot of changes this year. It's been quite a journey. And I think there's hope for everybody in the corporate world. I'm a lot more relaxed. This is a great life. And we're on the cusp of a massive growth phase. And for those of you who can see it, Celtec's going into hypergrowth. There's no question about it. I mean, you can tell just by trying to call in. I mean, it's really obvious. There's a worldwide boom going on in multi-level marketing. And we're not even out of the United States and Canada yet. But worldwide, some of the other companies are doing extraordinary things. I'm thinking right now of Nu Skin. You might have heard of them. They got into Japan in early '94, late '93, and they've already got 70,000 distributors in that country alone, averaging about 8 million. And that's a considerable amount of money coming out of there. Amway, who some of you might have heard of, they've got 100,000 distributors since starting in late '94 in Poland. Now, what makes that so amazing to me is the cost of a distributor kit is $60. In Poland, that's 60 American dollars. In Poland, that's 1 month's salary. So we're on the cutting edge of a hyper-growth phase, and those of you who get into this and really work your business, it's going to be a very, very profitable experience. And you're going to be able to do a lot of good. This is truly what I call right livelihood. Today I want to talk to you a little bit about attitude and a lot of the myths around taxes and the IRS and a number of issues that relate to our businesses. As you develop your business, you're going to find more and more of your income has to be looked at and dealt with, and you're going to have to become more careful with record keeping, because you don't want to give up a large percentage of it. You want to keep as much as possible and do as much good with it as you can. And there is a lot of fear out there about making money. A lot of people have confusion about, oh, I'm not sure about money. Money's, the root of evil, or it's no good, or this and that. Money is a very useful tool. And there's nothing wrong with all of us becoming millionaires and making effective changes in our communities. Things that we want to do with the environment, and we can have a lot of effect on local politicians. You'd be surprised what money can buy. I mean, you really would. Anyways, there's a lot of false information, and there's an attitude that only wealthy individuals can hire expensive tax attorneys who'll give them aggressive tax information. It's not true. All of you have the right to receive and get good information. The first thing you want to do is find yourself a good accountant, good CPA, somebody who's aggressive. First question you ask them, are you paying any taxes? And how much? What percentage? Because if he's not saving himself from paying taxes, it's not going to do much for you. So that's a good litmus test. Just ask, how's he doing? Does he understand network marketing? Does he understand multi-level? That's an important criteria. Remember, the greatest deterrent to your wealth is going to be this income tax. And this is not just federal, this is state and local. So there's a lot of issues you're going to have to look at as you develop. The tax code today is Byzantine. It's an art to interpret it. It's not a science. Okay, so different individuals will do it based on their own skill. So I want to talk to you a little bit about the myths about the IRS. The best PR firm in this country is the IRS. You're all scared to death. Every one of us. Everybody in the American countryside is scared of the IRS. And they projected that image. They've made it very clear that they want you scared because they want to keep you in compliance so that you'll pay your fair share and more because you're worried. So some of the myths. One of the big myths is the IRS is technologically so far advanced they can do anything. Big myth number one, not true. They're not even going to get their system up and running in terms of computers and application of software until past the year 2000. Okay? That's number one. Their funding's been cut quite a bit. They audited 1% of all personal returns filed in the last 3 out of the last 5 years. And from 1989 to 93, the number of tax auditors has dropped 21%. The number of revenue agents by 5%. So they're losing personnel quickly. When people go in for audits, they're finding, in many cases, the IRS loses their tax returns or they can't find them in their system previous years. So they immediately terminate the audit. Okay? But they've got excellent PR. That's where their money goes. Excellent PR. So I want you to be aware that a lot of this is attitude. I'm going to try and show you some slides. I had some trouble with my slides earlier on this machine. This is just to give you an idea. These are the states with your highest audit rates: Nevada, Alaska, Utah, Wyoming, California, and your lowest audit rates: Rhode Island, Kentucky, Indiana, Massachusetts, New Hampshire, and Ohio. Okay, this is just to give you an idea of what the states are doing or how the IRS is targeting states. Their main goal of targeting these days are individual returns and sole proprietorships. Any of you who have a business here at Celtec, basically you're working with a sole proprietorship. And what I'm going to show you towards the end of this, as I go into my talk, are ways to hide and get rid of all your expenses so that they're not seen. A little higher? Sure. Keep that there for a minute. These are your state tax bites. And this is what the states are doing. This isn't federal, this is just state taxes. Your smallest state tax bites: Colorado, Louisiana, New Hampshire, Virginia. Your highest: Massachusetts, California, Hawaii, Maine, Minnesota, New York. And the loveliest states in the United States, the ones without an income tax: Nevada, Texas, Florida, Washington. Now, I'm not advocating anybody move, but these are just the facts, so you know what's going on. Sure, I'll just leave that there. Talk to them. Attitude is critical. Your attitude in your Celtec business, your attitude in how you do your taxes. It's the same thing, basically. The story I like best is the story that the German philosopher told about the stonemasons. In Germany, they have a lot of Gothic cathedrals that were built over the centuries. And there was a German philosopher who went to 3 stonemasons who were working on a large building, and they were all doing the same thing. And he went to the first one, and he said, "What are you doing?" The first one said, I'm chipping stone. He went to the second one, he said, what are you doing?" Second one said, I'm building a wall. And he went to the third one and he said, what are you doing? The third one said, I'm building a cathedral. And so attitude is critical. How you view what you're doing, whether it's your business, your taxes, whatever, it's critical. Okay, your vision, as Daryl puts it, your vision of the whole, what's going on. It's how you view the process that's going to determine your particular tax bite, how you get hit or not hit, and how you can protect yourself. Now, once you've got your accountant in place, you're going to find that your rates are going to run anywhere from 15% federally to 39.6, which is the highest rate right now. If you add in a state tax like California, which is getting close to a little over 11% now, you're talking about almost 50%, which is quite a bit. I mean, that's a lot of money. So you have to keep good records. It's really important. And you've got to minimize your chance of an audit. The main thing you want to do is you want to get all your information on your tax return accurately, because that's the first audit trigger. It's all done by computer. Get your returns so that they sail through the computer system unobtrusively. You don't want them noticed. You just want it to go right through. That's your first main objective. I had a lot of forms here. I'm not going to show you most of them because they don't show up well on this. So I'm just going to go in, I'm just going to mention a few things as I go along, and you'll have to get these forms for yourself. Your income tax normally is based on your gross income. Now bear with me because this is a little dry. You take your gross income and you usually get rid of your deductions and your exemptions, and then you have what's called your adjusted gross income, the AGI they call it. Your expenses in running your own business are going to be critical. That's where you're going to save the most money. I feel like I'm a movie star here. Take the jacket off. Lighten up. Okay. Thank you. Okay, great, thank you. Last year I had to get you people down to your underwear before I could get up here. So now I'm starting. Okay, let's go into it. Let's go into the meat and potatoes, or rather for you guys, the tofu and veggies. We're going to start with your deductions, okay? Keep logs, keep diaries. I don't care how you do it, but keep something where you can record things. Especially you use your computer, your car, whatever it is. Keep some kind of diary or log that tells about how much time you're spending. You can write this down any time during the year. How much time you're spending using your computer, how much time you're spending using your car for business purposes, okay? You're going to want to do a home office. Most of us qualify for home office. We're all self-employed individuals. The basic litmus test or essence test is how many hours you're working in your home office and conducting business there regularly and exclusively. I'm sitting at home on my, with my phone quite a bit. So I use my home office a lot. Not only that, I also have another room where I have meetings. That counts too. Then I have another room where I keep all that inventory. My bottles of blue-green and tapes and books. So there's 3 rooms in my home. So let's assume I have a 3,000 square foot house. I might be using 1,200 square feet. Now you don't want to go over 40%. I just want to mention that. 40% is the key number. Keep it below that. 40% or lower. But you can do a lot of prorated usage based on that 40% figure. You can take a lot of deductions based on office furniture, fax machines, phones, your mortgage interest, your rent, your real estate taxes, your insurance, repairs, maintenance, utilities. Too fast, huh? Sorry, got a lot of material. Okay. Real estate taxes, insurance, repairs, maintenance, utilities, You can depreciate your home, and they allow you to do that based on either the cost of your home improvements over time or your fair market value, whichever is lesser. So all these deductions, postage, supplies, all this can go right on your tax return. Now normally, when you use a home office, there's a form they use called Form 8829. Form 8829. So Form 8829 is expenses for business use of your home. That form plus your Schedule C, which is your profit or loss from business, those two forms, plus a form called Depreciation and Amortization, Form 4562. Those are the three forms that most people use when they file their income tax. Now, I call these forms come and get me forms. Okay? This is what everybody uses, and these are audit triggers. Okay? A little later in the talk, I'm going to tell you how to make these go away. And still keep them, but make them disappear. These are your triggers. This is the kind of stuff the IRS is looking at. Home, offices, deductions, meals, business meals, travel, entertainment. These are your classic audit triggers. You want to depreciate the cost of your equipment and furniture over a 5 to 7 year span. Your accountant will help you with this. Now, I'm going to hold up my finger whenever I come up with my little secret tidbits that I found out for us as Celtecians. You're going to like these. These are my secret tidbits. So you know these are important when I hold up my finger. That means don't tell anyone. Okay? You can take office machines and furniture that you bought in the past that you no longer have receipts for because you bought them a while ago and convert them from personal to business use. In other words, I have a large Chinese antique desk at home. Cost me $1,500 at an auction. And I have a number of Persian rugs. I think they cost me a couple $1,000s at least. And I can convert those. And the IRS will accept that because it's being converted from personal use to business use. So just remember that as something you can talk to your accountant about if you have anything from fax machines to phones, copiers, whatever it may be, your conversion activity, you're allowed to convert. And the IRS will have you do it based on the fair market value at the conversion or the original cost, whichever is lesser. So you have to decide on a Persian rug that might have cost $2,000, has it appreciated to $3,000 or do you want to use the $2,000? It's up to you. There are three methods of depreciation. I want to mention this too. There's what they call straight line, 200%, and something called Section 179. Just keep that in mind, Section 179, when you talk to your accountant. Say to him, what's Section 179? On depreciating goods. You're depreciating over a period of time. That Section 179 allows you to take almost up to $18,000. I think it's the max this year is $17,500 of a car, business equipment, furniture, whatever you buy this year, and take those expenses immediately against your current income. Okay, you don't have to do it over 5 to 7 years. So just mention that. All these other things that can be depreciated, remember, copiers, fax machines, phones, couch, computer, desk, typewriters, filing cabinets, fixtures, calculators, supplies, whatever you have, okay? Another audit trigger, but which you want to take, are entertainment expenses, travel, meals, advertising. Business meals and entertainment right now are 50%, down from 80 this year, but all the business meals and entertainment are deductible. That's food, beverage, taxes, tips, tickets, cover charges, whatever. All your travel, airplanes, trains, cabs, it's 100% deductible. I'll give you an example. you are the sponsor, you take your new distributor to the ball game. You go there and you watch the game, have some food, and you talk about the business a bit in between innings. And that whole process is 50% deductible. The cab to the stadium was 100% deductible. The limo, excuse me. I'm sorry. I said cab. I know, my vision dropped a little. It got smaller. The limo. Hey. I knew you were a creative group. I just knew it. Meals. When you take meals under $25, the IRS allows you to do it without a receipt. So keep a log about your meals. They'd like you to have a log. That means you write in the date, who you're with, the business you discussed. Heck, we're going to discuss algae, right? Just keep a log. Under $25, you could do 2 of those a day. I wouldn't overdo it, but you could do quite a few meals, okay? If you figure that out, that's quite a bit of money in a year. All your office expenses and your advertising expenses, those are 100% deductible. Inventory, algae you're required to buy, it's all deductible. Auto expenses, keep logs on your auto. Try to use a specific credit card for your auto. 29 cents a mile now for business usage. And it's inventory. I don't know what you're doing with it. You have to decide what you're doing with it. I don't know if you're using it for gifts to people to show them the algae or what. You decide what you're going to do with it. It's inventory. Let's get that clear. Okay? It's inventory. Okay? Let's not bring in personal use or any of that stuff. We don't know, inventory. Okay. Auto expenses. Oh, go ahead. Sure. Yes, I'm going to do that right now. Repairs. Okay. If you're deducting mileage, can you also deduct repairs? Yes. Repairs, gas, and depreciation, all deductible. Tolls, parking, all deductible. On a business car, I think you might be able to work that out. Image.
How about keeping the questions till the end?
Good idea. I like that. We'll keep the questions to the end. All of that's prorated on a usage basis, how much you use the car for business. If you have 2 cars, you could say one is pure business, one is for the house. Or you could say, there's 2 of us in the business, we each use it 80%. Everything will be prorated based on that percentage. You decide. You have to decide how much you're going to use. But if you figure you drive 5,000 miles a year for business, and that's real small, 29 cents a mile, you're talking about $1,450 right off the top. That's pretty good deduction. And a lot of us probably drive a lot further. I drove across the country to get here. 3,000 miles one way, 3,000 miles the other way. Who knows where I may go on the way back. Oh yeah, remember? This is a good one. Telephone usage. Now, of course, you've got your telephone usage, and you're using your telephone mainly for business. We all know that. Your Concorde is pure business. And you're going to have a calling card. But you're out there like I'm here now, and I need to call somebody in my downline. I have change in my pocket, so I'm going to make this call at a pay phone. I'm going to start using these quarters one after another. I can't get a receipt on that, right? So the IRS, in their wisdom, has allowed us $30 a week, roughly, from pay phones. Okay, $30 a week, roughly, you can use in coin usage, 52 weeks a year. But don't tell anybody I told you that. Now, I was sitting this morning when I got up, I went to the restaurant and I got some coffee, a lot of coffee, and some orange juice. And this couple were at the next table, and we were chatting. They saw my little, armband, and, they had theirs on, and we were chatting. And they said to me, "Oh, God, we got a great deduction." I said, what is it? I'd love to know. They said, "We have a 7-pound poodle at home. And that poodle is our guard dog." So those of you with your attack cats and your Amazon parrots, this could be security. I don't know. You have to discuss this with your accountant. I didn't know about the poodle till this morning. So I just wanted to bring that up, that it's amazing what you can pick up on these trips. Okay, another question they asked me, and which I happen to know the answer to, which is rare. Which is better? You get a better tax saving by leasing the car. I didn't know this till recently. I had to research this. It surprised me. I thought buying would be better. It's not. You lease a car. Say you pick a car. I picked one at $27,000. And you lease it for 4 years. Your payments are going to be roughly $400 a month. And that's going to run about $19,200. $400 a month, 4 years. And that's 100% business use, of course, because you're using that car just for business. And you'd only add back to your income over that 4-year period $715, which means you have a net tax deduction for 4 years of $18,485 on a $27,000 car, which you get to use exclusively for 4 years. Now you buy that same $27,000 car, and your monthly payments are going to be closer to $600 a month for the 4 years, and your depreciation deduction on your tax return is going to average about $12,185. The difference between the two, $18,485 versus $12,185, is about $6,300. If you're in the 31% tax bracket, we're talking a savings of almost $2,000. Plus, you've saved over $200 a month in cash that you would have had to pay out. The downside to leasing is that you've got to keep that car, and you don't get to use it for more than 4 years, basically. It's a 4-year lease. So you have to turn it in every 4 years to get a new one. But when you buy a car, you do get to use it for longer, 7 years, maybe 8 years. But I think for you Celtech millionaires, you're going to want to do it every 4 years, I would assume. Some of you probably every 3 or 2 years. So it's a lot more advantageous. And, I found this out this morning. That business car, if you ever have an accident in it, that's all deductible. If you have to settle the claim, that's deductible too. I didn't know that. So I want to recommend, if any of you are wondering what is better, because I get asked that question a lot, leasing is better in terms of tax deductions. Now, your success in this, this is one of my little pithy comments, your success in this doesn't depend on how big you are or how much money you make, but on your ability to maneuver, be adaptable, and your speech. That's why the lion's king of the jungle, not the elephant. Okay, because he roars and he's very maneuverable. Now here we go again. This one I like. Spouses on business trips. How do you make your spouse completely deductible on a business trip? I love this one. You sign them up, of course. Rule 13, though. But you can deduct the cost of taking your spouse on the business trip. How? Here are the guidelines. Number 1, you explain your business to the spouse. Hi, I'm taking algae. 2, you involve your spouse in interacting with people relevant to the trip and to other spouses. Hi, this is my spouse, and we're both taking algae. 3, set up dinners, seminars, or parties to which spouses are invited and business is discussed. Excuse me, would you pass the enzymes? 4, eat all your meals with business associates, discuss business, and get your spouse to participate. Pass the ketchup and the enzymes. Okay. 5, this one I love. You must document your spouse's ideas on the business, no matter how outlandish they may be. Algae mouthwash, algae bubblegum, acidophilus suppositories, whatever your spouse comes up with, you have to document, your spouse came up with these ideas which are relevant to your business and they're helping you. They really are. And your spouse can then be included on your business trip. Interest deductions, mortgage interest. Now you all know right now consumer debt interest is gone. You know that. You've probably been told that. But mortgage interest, your main residence and one other residence up to $1 million, you can deduct the interest. Before 87, if it was put in place, there's no dollar ceiling. If you have consumer interest, you might consider a home equity loan. I suggest this to people. Get a home equity loan because pay off all your consumer debt, and then that home equity loan, the interest is all deductible. Investment income, if you borrow money from somewhere to make investments, that's deductible. I'm going to just briefly mention medical expenses. Medical expenses are also deductible, and when I get to the next section on how to avoid audit triggers, like the Schedule C and that Form 8829 and that other stuff I mentioned, form this, form that, you'll find that one of the suggestions I make, your medical expenses will become totally deductible without that 7.5% AGI figure that they use now for itemized deductions. So I'm going to talk about that in a second. First, I want to talk about medical expenses that have been upheld by the tax court and the IRS. I'm just going to breeze through this. I'm going to whiz through. These have been upheld by the tax court. Of course, traditional medical dental, acupuncture, contact lens insurance, dentures, detachable home installations like air conditioners, heaters, air cleaners, humidifiers, dust-free rooms, maintenance costs on home swimming pools if it's prescribed for an illness. I'm sick, I need a swimming pool. I gotta swim every day. Please, doc. Sex counseling, special diets. I don't know what it is either. I mean, special diets, yeah. Stop smoking programs. This one I love. This is my favorite. Train cats. This has been upheld by the tax court. Train cats. If you're hearing impaired, the cat alerts you to unusual sounds. So if trained cats can do it, trained gerbils, trained parrots, take your pick. Wigs. Hair pieces. They alleviate the mental stress of hair loss. Believe me, it's a strain, losing your hair. It is. You can have your doctor prescribe vitamins, aspirin, and hey, why not algae? Why not? I mean, it's quite nutritious. Okay, let's get down again to the meat, tofu and veggies. Self-employed people, as I said, are greater audit risks. So we're going to move on to 3 ways to prevent audit and your chances of audit. One of them I'm going to rule out immediately. That's a C corporation. It's called a C Corp, regular corporation, because they're double taxed. They tax them at the corporate level and at the shareholder level. They tax them both ways. The 2 things I want to talk about, which I'm going to go into a bit, are called S corporations, which are small business corporations, and partnerships. You've got to move this way. Either one, but you've got to do it. If you're going to do a home business and you're going to start making money here, and I know you all are, you're going to want to do this. You're definitely going to want to do this. An S corporation has a lot of advantages of a corporation, along with the same favorable tax treatment as a partnership or a sole proprietorship, which you all are now probably, sole proprietorships. They were introduced in 1958 as mom and pop operations so that you could gain the advantage of incorporation, which means limited liability. Limited liability. Okay, that's what a corporation does for you. Your liability is limited. And it has perpetual life. It can keep going and going. The kids could come in as shareholders. It can go on and on and on. All the income basically passes through the S corporation right to your 1040. And you can decide how much salary to take and how much the kids take and this and that. The gain appears on Schedule E, and there's a special schedule for this S corporation called 1120S. It's called a U.S. income tax return for an S corporation. I don't think this is going to show up on here, but I'll put it on anyways. Maybe it will. Anyways, the main thing is 1120S. That's all you need to know. these corporations get a lot less attention. In fact, you avoid all the targets, triggers, and special programs the IRS has in place. You avoid them all with either an S corporation or a partnership. You avoid everything. Your home office expenses, remember I mentioned those before, you need a special form called 8829. That disappears. There's no disclosure of home office expenses. It just goes on this form in another way. Travel, entertainment, auto expenses, they get a lot less attention on an S corporation because the audit rate is really low, very low. In fact, the smallest percentage of business returns that are audited are S corps and partnerships. They're very small. 1993, it was like 1%, and partnerships were like 0.6%. So you can control your salary, you can reduce your FICA taxes, which is Social Security and Medicare. And one of the reasons the IRS allows this is because they'd rather go after a C corporation. You see, a C corporation, which is a bigger one, an S corp can only have 35 shareholders or less, and I'm sure your family isn't quite over 35 people. It could be, but if it is smaller than 35 people, if you're a regular corporation, they can be doubly taxed in a regular corporation. If the IRS disallows travel and entertainment expenses or something they don't like in a C corporation, they hit that C corporation at both the corporate level for taxes, they disallow, and they pass it through to the shareholder on his tax return. So they hit them both. They're double taxed. On an S corporation, if the IRS doesn't like your travel and entertainment because you went on a world tour of restaurants to see who carried enzymes, they will only hit you once. They'll just disallow the deductions and it'll go into your tax return as regular income. That's it. They won't double tax you. So because of that, the IRS doesn't spend much time with S corporations or partnerships. They don't make much money off of them, which is very favorable for us because we should be doing this. It is the thing to mention to your accountant. Is that readable? Oh, well. I'm hitting autofocus. Don't you love technology? Now it's beeping at me and it won't stop. Okay. Anyways, if you can't read it, the gist of it is that when you look at Schedule C, people who report 100,000 and over, which you're all going to be doing very quickly if you're not already. In 1992, there were 1,500,000 roughly returns filed. They examined over almost 62,000 of them, which is almost 4% examined. On S corporations the same year, they had 1,800,000 filed, which is even more, and they only examined 1.02%. On a partnership the same year, they had 1.6 million filed. They examined 0.61%. So people who had Schedule Cs, which is what we all do now, filing our deductions and our sole proprietorship, they had over 6,761,000, it's over here, and they examined 2.71%. So it's roughly a fifth or less. So S corporations and partnerships are the way to go. There's no question about it in my mind. How do you do an S corporation? You incorporate. If you go to an attorney, it'll cost you somewhere between $600 and $1,000. If you do it yourself, go to the Department of State in your home state, and they'll give you the forms and the fee schedule. It's about $375, roughly. You obtain a federal employer ID number. It's called Form SS4. You send this off to the IRS. It takes about 3 weeks. And you file a form called 2553, election by a small business corporation. Basically, election of an S corp. You file that with the IRS. 40 states recognize these now. New York charges $325 a year. Florida, it's free, zero. California and Illinois, it's a 1.5% tax rate on S corporations. If you have a state with high income tax rates for the state tax, don't elect for the state purpose. In other words, you can do what's called a split election. You can elect this for your federal return, but not your state return. Okay? Now remember, the IRS is going to say, oh, this is horrible, don't do this, don't do this. These are good. These are good. And your accountant, that aggressive accountant you got at the beginning, the one who's saving, he knows all about this. In fact, he's going to recommend either this or he's going to recommend a simple partnership. Now, a partnership is real easy. Husband and wife can do that. No filing requirements. No registration. No Schedule C. Probably no self-employment tax. Your home office, that's gone. Nobody's going to see those expenses. And if he's a smart accountant, he's going to add a business trust to this simple partnership. And business trusts have a 0 audit rate. They don't even audit them. Now you're single, you say, I don't have a husband or wife, I'm single, how do I do this? Well, your accountant, if he's a sharp accountant, he may say, hey, there's a way to do this. We set up a limited liability company, which is used as the second body of the partnership. We use that liability company to help us do this. The only negative with a partnership is you still have liability, whereas with the S corporation, you don't. That's the only basic difference. In either one, I'd recommend you might consider hiring your dependent child if they're under 18, because the first $3,800 of their wages is not subject to income tax, because that's the standard deduction for single taxpayers. And the next $22,750 of income that child made helping you with your business is taxed at 15%. Now, that's about all I'll say on that. Those of you in the back row, the 150 of you millionaires back there, I want to suggest the Cayman Islands. It's a wonderful place. And we'll talk about this down the road when you're all making $1 million or more. Offshore. We'll talk about that at some point in the future. Those of you who are millionaires already know about it, probably. One more thing I just want to add. You can reduce your tax bill by splitting your income in these corporations and partnerships with other family members. Each family member, let's say in an S corp, owns stock in the corporation, because you can have stock in this corporation. So each person reports his or her share of the income that's coming in on this S corporation, up to 35 members of the family, with the kids being taxed in the lowest bracket. So if kids are over 14, they're not subject to the kiddie tax, and anyone in the family who's in a low bracket, granny, grandma, who's ever helping you with the business, they can get part of that income taxed at their rate, which could be 15%. I mean, I don't know what they're paying. Another suggestion I have for you is a SEP IRA. I mentioned this before. It's a simplified employee pension IRA. It's a retirement plan. You can put in SEP IRA, SEP IRA. Just mention that to your accountant, SEP IRA. You can put in 15% of your net after Social Security taxes, up to $30,000 maximum annually, 100% deductible. It can be open and funded until your return is filed. The formula they have that they work on this will come probably a little bit less than $30,000, but that's how much you can salt away, which you can then invest any way you choose because you control it, but you can't take it out to your 59.5 unless you want to pay a 10% penalty. Then there's no problem, there's no penalty. You can keep it going. At 70.5, you're required to pull the money out in installments over a period of time. So I want to recommend you all start saving. 1981 to 1993 in this country, the public savings rate was about 0.5%. So pay yourself first, 10 to 20%. Japan and Germany, they're saving 25 to 35% of every year's money. Set up your IRA SEP, get yourself a good accountant, set up an S corp or a partnership, keep good records, logs, diaries, convert everything in your house to business use, You can go out and buy real estate as an office, get together, a few of you, buy a group office. Just because it has apartments and a swimming pool, it's still a group office. And even if it's a real estate investment, it's still a group office or your own office, whatever. You can hire your kids or others to do a lot of low-level work for you, like labor, phone work, mailings. That's all deductible. Remember your Celtec boat, plane, and limousine. Those are all deductible. I want to emphasize that you have to start saving. I don't think you're going to be seeing much Social Security. All the Social Security today that we pay in goes right out. It's not being saved. They're putting in IOUs for the future. Okay, so I would start to save for my own retirement. I would assume that that's something you must all do. The government, you know, is a debt junkie, as I call them. I like P.J. O'Rourke's quote. He says, giving the government power and money is like giving a teenage boy whiskey and car keys. I love that quote. I love that quote. Your Fed is like a pusher for this government debt junkie. So we've got $4.5 trillion in national debt and $13 trillion in off-the-books debt. Off-the-books debt. Social Security, unfunded government, military, government employee, pensions. It's all off the books. 60 cents of every dollar now is going to fixed entitlements. So we're kind of we're caught in a web we're going to have trouble getting out of. Just now the debt rose $40,000. $13,000 a second, $47 million an hour. That's the interest. Okay, so I'm up here for 47 million plus. Our trade balance. I wanted to show you some charts. These really drove it home to me. Our trade balance. You hear a lot about the Japanese and the trade balance with them. Now, let me see if I can get this thing down. No, the other way. You may not be able to see this, but too bad. I'll emphasize what it is. This is the Japanese yen. That high point back up here is 1985. You had 260 yen at that point to the dollar. As of right here, which is 1995, just a month and a half ago, you had 80 yen to the dollar. So we have a trade imbalance with Japan, and the yen, which is symptomatic of the other currencies, the dollar has been doing this. It's been going down against these currencies. So your money has been losing purchasing power. I don't need to tell you that. Any of you who remember $1965 or $1975 and now $1985. So we're losing money quite dramatically because 260 down to 80 is quite a lot in 10 years, if you think about that for a second. And the dollar is reflective of our money and its purchasing power everywhere in the world. Now for investments, I'm going to talk just for a minute. My analysis hasn't changed. We're in what I call a blow-off phase in the stock market. I recommend you all stay out of the stock market. Everyone is bullish. Everyone. Every time I go to any investment seminar or anything, people are telling me, oh, the stock market, it's going to do 12% a year. It's going to keep on going and going and going. Well, I call this a blow-off phase. This happened in 66 to 68, 73, 74, 1929. That was a famous one. This is a blow-off phase. You don't want to stick around in this phase. It's a dangerous phase. So I recommend forget stock investments. I know people are going to tell you contrary, but that's my opinion. If you look at that chart of the Dow Jones that's up there, that's a monthly chart going back to 1984, you just see a steady up move except for that two-day bear market. Remember that one in 87? So investment professionals going back to like 1980 today have no experience with a real bear market. They just don't remember them. They're too young. Okay? I came in the business in 81, and I was seeing the tail end of a bear market. And since then, the Dow broke 1,000 and just kept going. People say to me, well, what about the Japanese? See, here's the Japanese. If you look at that, back in 89, at this peak up here, the Japanese market was at 40,000, and people were saying, oh my God, it's going to keep going forever. You heard the same kind of talk. Everybody was bullish in Japan. Well, now it's down to almost 14,000, and I'm expecting probably somewhere off the charts here towards 8 or lower. Japan's got some big problems now with their economy, their money, their banks, because everything in their asset structure was denominated in stock and real estate. And you can see what happened here at this peak once it was met at 40,000. Now we're down to 14 and going lower. And it never really recovered, because this happened in '89. These are utilities. People say, what about utilities? They're nice and safe. These are utilities, and this goes back to about 91. You can see we've been in what I would call a bear market in utilities probably since late 93. And utilities applies also to interest rates. People say, well, rates are coming down. We've got no problem with interest rates. 1993, same time period for utilities. We hit 5.79 up here, 21-year low. And these are U.S. Treasury bonds. This determines the interest rates in the United States, how rates move. Okay? As bonds go down, rates go up. So we hit this low up here at 5.79, dropped down to 8.25 here in 94, and since then we've come back to about 6.28. And now we're headed again, in my opinion, this way. And I'm expecting 9.5 to 10.5 on interest rates, which I don't think is going to be helpful for the stock market. If you look at this chart and you go back a bit, you'll find that in 1984, which is off the charts back here, rates were around 12% on these bonds, 12 and 13%. So I think we're near the historic lows in interest rates. So if you can lock in long-term mortgages, do it. I wouldn't suggest those ARMs anymore. I'd recommend fixed 15-year mortgages and make bi-monthly payments, because bi-monthly payments save you a lot more interest over the long run, a lot more. This is silver, which if you look going back to about 84, was up to about $11. Back in 81, it was off the charts around 52 when you had that massive inflation you all probably remember, and the Hunt brothers and all that. Anyways, we've come down to a low down here of about 360. Since then, we've gone to about 620. And my projection now is about 7.5 or higher. Gold, I expect 460 to 500. So I like silver and gold. I like a little bit in every portfolio. I recommend a couple of stocks, particularly. If you're going to buy stock, I recommend Coeur d'Alene, the silver mine. If you're going to buy gold, I recommend Agnico Eagle. The symbols for those are CDE and AEM. People ask me, what about stockbrokers? Financial professionals, business I was in. Well, you want to go to your stockbroker, and the first question you want to ask him is, are you under indictment? That's your first question. If you get a good response, then you ask him if he goes with the stockbroker's philosophy, which I think I told you last year. Be nice to people until you make $1 million. After that, people will be nice to you. Okay? He's got an automatic conflict of interest. I'm a stockbroker. You come in, you've got $10,000. Well, you want a nice, conservative, safe investment. I say, well, if I say to you, hey, buy treasury notes, 1 year, 2 year, 3 year, 4 year, 5 year, keep rolling them every year and take advantage of rising interest rates. If they're rising, you keep rolling them as rates go up, right? I only get about $25 on your $10,000 investment. Instead, I say to you, how about a mutual fund in bonds or stocks or Ginnie Mae's? God, safe, Ginnie Mae's. I make 5% on that. Of course, he doesn't say that, but I make 5%. That's $500. Either front-loaded, back-loaded, or they say these are no loads. Well, they don't tell you about the management fees and the net asset value fees that are built in. There is no free lunch. If it sounds too good to be true, it is. All those aphorisms are absolutely correct. This is not the time to be messing around with your money. This is a time to stay somewhat conservative. You want to risk 10% maybe, but you want to build your asset structure right now. People ask me about insurance. I say forget it. The only insurance you need is if you're young and you're worried about your kids, get term insurance. 10-year fixed term, make the payments, take care of your family, that's it. Insurance is a rotten savings vehicle. The only ones that make out are the insurance companies. Limited partnerships. As Nancy Reagan used to say, just say no. 20% up front is generally hidden in every perspective. You just never see it, but that's how much they hit you for on most limited partnerships. There are a few good ones. I've never seen one, but I've heard there are a few good ones. Now, I've only been doing this 14 years, so I know there are people more experienced that have probably seen them. I haven't. Mutual funds. Right now, they're collections of bonds or stocks, all different kinds. In fact, when the market gets this kind of overheated activity, you get thousands of mutual funds. 75% of the money in the mutual funds now came in the last 4 years at very high rates. And people are convinced this market's going forever. I like the monkey story I just heard recently. They took a monkey and 9 money managers. And they had the monkey do the darts, you know. And the money managers picked their stocks. The monkey picked his. And the monkey came in third. So this is after a year. So they asked the top 2. The first one said it was just an accident. This couldn't happen. The second top money manager said, I'd like to hire him. It's a true story. So for all I know, that monkey is a Dean Witter today, you know, running arbitrage or something. People say to me, what about commodities? I love commodities. You want to make a small fortune in commodity trading? Start with a large one. I guarantee you'll end up with a small one. Switzerland. Switzerland will give you 3 to 5%, take 3 to 5% of your income, and they will give you residency. And they've got a lot of wonderful investments. It's kind of expensive. You can buy residency in Peru for $30,000. But if you want to do some international investing, nothing wrong with Swiss francs. They're partially denominated in gold. Risk fund. Last year I told you about a risk fund up here called Robertson Stevens Contrarian Fund. It's a no load, you know. 800-766-3863. That's their phone number. 800-766-3863. Risk fund primarily shorts the stock market. They've got 24% short on the stock market, 19% in base metals, 16% in gold, 1% in puts, 6% in cash, 4% financial. And I told you last year, a year ago, at the celebration, buy this fund. Even though they were going short and the market's done nothing but go up, they're up 22% in the last year. So they're going to do really well when the market goes down. Okay? But that's a risk fund, pure risk. Okay? That's like gambling. Don't let anybody tell you the stock market's not gambling. And the bond market, to some extent, is also gambling. Unless you're in such a high tax bracket, you just want to buy long-term municipals that are AAA insured rated, put those away, get tax-free income, that's fine. Now, it's tricky to find honest brokers. I was in the business 14 years, and I talked to a lot of them, and I had trouble with some of their activities and their requirements because they have a built-in conflict of interest. Remember, the treasury note versus the mutual fund, $25 versus $500. You know, so you have to kind of watch. I have a friend now in my downline. He's here today. He's a stockbroker, and he's almost a sapphire, so he definitely understands the business. I just want to introduce him to you in case you're interested in a stockbroker. Michael, would you stand up? Michael? This is Michael Sullivan. Michael's with my old firm, Dean Witter. Michael, I just want to ask you one question. Are you under indictment? You were acquitted. Very good. So he's what I call a smart stockbroker. Okay, let me see where I am. I was going to ramble on a bit here about the S&L mess and some other things about the government. Basically, I just wanted to tell you don't count on Social Security and The S&L mess, which was a $15 billion mess back in '86, now is a $500 billion to $1 trillion mess that we have to do. By the way, that's also unfunded. It's off the books. Be careful about the federal government and putting your faith in them. I would suggest you put your faith in SEP IRAs and savings and creating your own retirement of some kind. You want to remember you want to try not to lose what you're building. The government doesn't require banks to keep much in assets. You know, the S&Ls had roughly only 3% of their money in assets, and they counted those temperature and time signs as part of their assets. Okay? Federal law requires now banks keep about 6% of their money in assets. That's a technical term for our money. Okay? And they also have something called reserve capital. That's what you got on you right now. Okay? The banks don't have much on them right now. They've been loaning it out at the rate of 10 times what they take in. So I don't want to get into it, but I can tell you the S&L crisis was precipitated because the government allowed a lot of funny things to happen and still do. They had something called land swaps. This is my favorite. I just want to mention this one. This is called a land flip. A number of S&Ls use this. I go out and I buy an acre of swamp somewhere. I go to you and I say, hey, please buy this acre of swamp from me. You give me 10 grand for it. I say, oh, wait, I made a mistake. I want it back. I'll give you 100,000. I make a note for 100,000. You decide you want it back. Finally, we get it back and forth up to $1 million. We go to the S&L, and we use the acre of swamp for collateral, get the $1 million, and darn it, we default. And we lose that acre. Darn. So, the federal government has trouble delivering mail, and that's got our name and address on it. So how hard can that be, right? So you got to take care of yourself. Your business here is very appropriate to taking care of yourself. There's a lot of things I could ramble on about, but don't put your faith in legislators, because when buying and selling are controlled by legislation, a rule of business, one of the first rules of business, is that the first things to be bought and sold are legislators. So I like this saying. I'll end on this and we'll go to questions. I love this saying. It's called, put not your trust in kings and princes. Three of a kind will take them both.